Good afternoon, everybody, and welcome to our Twitch TV live stream. My name is Glenn Tompkins. I'm a senior instructor here at VectorVest, and if you can hear me, by all means, chat out in the chat room to let me know that you can hear me. It'd be greatly appreciated. We're doing a couple of different new things here, so I'm just trying to make sure that all of the technology is working. So if you can hear me, it's important. Even if you don't normally chat, it is important today that you can let me know that you can hear me, all right? So I need as many of you to chat in as possible to let me know that the audio is going across. So Lisa, you say good afternoon. Does that mean you can hear me? Or are you just typing in? I just need to know, all right? So again, I need as much feedback from you guys as possible to let me know that you can hear me. All right, so checking. What's the delay?
I think we're 20.
All right.
Yeah, okay.
All right, let's see. You can hear me. Elisa, how many people?
6.
All right, so I know I've got more people than that. I need to, well, if Lisa can hear me, then I'm going to assume, excuse me, if I'm not having anybody else chatting in, I'm going to definitely assume then, this is one of the few times I will do that you can hear me. All right, Digital Tectonics can hear me. All right, again, this is one of those times we're doing a lot of different moving parts in the background. That's why I need the feedback. As you mentioned, or as I mentioned, I am a senior instructor here at VectorVest. I've been here for 15 years, good number, 15 years. And the software that we use in this channel is VectorVest. The software has been around, thank you, Ralphie. The software has been around for about 30 years. And today we do have a special guest as part of the VectorVest family, and his name is Ron Wheeler, and he's our options expert, guru, however you want to call it. And if anybody, there he is, now you can see him, that's Ron. That's a nice picture of Ron. Ron, that's a nice picture of you. And
Thank you.
he's going to be live with here, and if any of you have options questions, guess what? You are in for a treat today, because just about any and every question you have about options, I believe Ron will be able to answer, and in great detail. I've been on the road with him. He can talk. But it's not that he can just talk. If you listen to what he says, your options trades are going to turn around tremendously. I've had the opportunity to take some of his training by way of the videos that he's created, and there's a lot of them. And man, if you want to learn about options, he has a unique way of simplifying the options arena. And, you know, I've given a basic options talk here in Twitch, and I said there's 4 things that go along with options. The whole basis of options: calls, puts, buying, and selling. That is what makes up options, and any combination of those things will make up the trades that you have in place. Then there's things like knowing what are the best options to get into by some of the characteristics that you look for in options. And without having the training, you're not going to know what characteristics to look for. You also know that options have a time expiration. Knowing when to put the right expiration on the type of trade is extremely important. And if any of you have never traded options or have traded options and weren't able to be successful at it, this is the day. This is your opportunity to get in touch with and listen to one of the most amazing people in regards to options. So with that, how about Lisa says, yay, we all know options confuse me. This is a time to get some of that confusion out of the way. And by the way, John, I'm glad you're here. Ralphie, again, thank you very much for chatting in as well. And a lot of people who may be sitting in the background, this is the day for you to come out from behind the scenes to get your options questions answered, especially if you are brand new to the options arena. So with that, let me introduce a great, heartfelt introduction to Ron Wheeler. And Ron, tell us a little bit about yourself.
Sounds good. Thank you, Glenn. I've been trading now for 22 years. I started back in 1997, and I haven't been doing options my whole career. I actually got started in 97 as a futures trader. I was trading S&P futures. I was trading currencies and all kinds of different stuff on the future side, crush spreads, crack spreads, soybeans, wheat, corn. And I did that exclusively till about 2012, and I did very well at it. Right around 2010, one of the mentors that really taught me how to trade started to get into options, and he kind of started to expose me a little bit into the options world. And I kind of made the decision around 2012 that I wanted to start reaching out a little bit more. The downside of trading the commodity markets and futures, and especially the way I was doing it, I was day trading. And again, I mean, I did very well at it, but you have to be in front of your screen for, 7 hours a day. And there gets a point where it doesn't matter how much money you're making if it's just a grind and every day is just like Groundhog Day over and over again. So I started to see some of the things that you could do with options to where you could really start putting the trade in your favor. Let me kind of explain how that works. And I don't buy a lot of calls and puts typically. I do a lot of spread trading, which whether there's debit spreads and credit spreads, I do all kinds of stuff like that. But one of the things that really attracted me towards the options market was I could construct trades that had probability built in for me. If I was trading corn or if I was trading the S&P, if I bought the futures, the market had to go up. If I sold them, it had to go down. I learned how to construct trades where even if I was wrong, where the market didn't go up, I could still become profitable on the trade. That took a lot of the work out of the equation. I didn't have to worry about, all these things like Fibonacci and Gann and all kinds of studies and indicators. I could use base level analysis and then construct the trade to give me a good chance of success. And I learned that over the course of a couple of years and kind of dabbling and still doing a lot of futures, but then kind of doing more and more options. And I'd say probably about, I'm going to say 6 or 7 years ago now, I pretty much switched over to where I'm going to say 90% options trades. It's not a scientific 90%. I still dabble in commodities because it's something I like to do. But very rarely, will I do that now. It's mostly just option trades on either SPX index options, and then I also trade a lot of stock options as well. So I've been primarily options now for, about 7 or 8 years.
All right, so now with that, a good basis of understanding Ron's knowledge in options. And when I tell you it's extensive, I'm not just whistling Dixie. Now, a question has come up, and again, folks, this is the day, this is the time to ask any questions that you have in regards to options and how to either improve your options trading now or how to get into options trading as well. Ralphie asks a question. Do you need a lot of money to sell premium?
It's a good question. And the answer is yes, if you sell it naked. And the key there is naked option selling is kind of what you're referring to, where you're selling a call or you're selling a put with either out the stock to back it up, or in the case of a put, you would be selling it, which is called cash secured. And in that case, you would need a lot of capital to do that. Now, even with what I trade, money wise, I very, very rarely sell anything naked. I usually use what I like to call protection. So if I sell a put, what I'll do is I'll buy a put to back that up. So instead of using the stock or capital to lock that trade in, let's say I sell a $100 put on a stock. I might go and buy a $90 put. And what that does is it reduces my risk in the trade down to $10 because that's the spread. And then I don't have to put out the huge amount of money for it. And I do the same thing with calls. If I'm selling a call, I can buy a call to substitute for the capital or for the stock requirement. So if you do it that way, it doesn't really require a lot of capital.
And also be careful with selling naked, because as a seller, you have the obligation to provide the stock or take on the stock, whether it's put to you or you have to provide it to the buyer. There's a lot of expectations if the trade goes away from you. But I like the idea, as Ron just talked about, if you offset it with buying a call or a put, now you can still play that trade, whether it's directional or not. Pretty much it'll be directional for the most part. but now you're not responsible for having to provide the stock or get it put to you, which is important. So that is a good way to get around having a ton of capital to sell premium. Does that make sense? Hopefully it does. All right. Okay. That was, okay, there we go. Thank you. In the background, of course, you know I have my producer, Joey. Joey, say hello.
Hello.
There we go. All right, now, Lisa has a question. She says, I understand the concept of buying options. Puts are what confuse me. So, Ron, explain a little bit about how puts work in regards to how calls work.
Okay. Well, puts, if you think about it in the terms of stock, put is basically the equivalent of being short the stock. So if you think that a stock is going to go down, you would buy a put because that gives you the right to sell the stock. So if I buy a $200 put and the stock goes down to 190, I have the right, I'm sorry, not the right to buy, the right to sell. I have the right to sell the stock at 200. Now, a lot of people get confused on, well, how can I sell something I don't own? Well, you're not really selling it. You're borrowing it from a broker's inventory. And then, you know, even on that, you really don't have to worry about it. You know, what was explained to me way back in the day is don't always think about the behind the scenes transaction. Just be aware that you're buying paper and at some point in time, you're going to be selling that paper. Now, that paper has obligations and rights attached to it. What those obligations and rights are attached to it, I hesitate to say this, but sometimes you don't have to worry about that. But the basic underlying premise of a put is it's the equivalent of being short a stock. If you buy a put, you want the stock to go down because it gives you the right to sell a stock at the strike price. So you just buy the put. Now, in the terms of selling a put is typically something you would do on a bullish market, right? Think about what buying a put does. Buying a put gives you the right to sell a stock. So if a stock's at $100 a share, and I think it's going to go up, I might sell a $95 put. Now, I want you to think about this in terms first of buying. If you were to buy a $95 put on a stock that's $100, if the stock goes up to 105, your put would start losing value because the market's going the wrong way. Let's say you bought it for $5 or bought it for $5. As the market starts going up, your put, which was worth 5, is now worth 4, 3, 2, 1. And then ultimately, if the market just keeps going up, because remember, buying a put is a bearish trade. You want the market to go down. So as the market goes up, your put that you bought, because remember, it's the equivalent of being short the stock, starts to lose all of its value. Now, when we sell the put, okay, what we're doing is we're taking on the obligation to buy the stock at, let's say, $95. Well, if the stock goes up, that put that we sold for, let's say, $5, well, guess what? Same thing still happens. As the market or the stock goes up, now your put that you sold for $5 becomes worth 4. Well, options are a tradable item. A lot of people get this misconception about options where, well, if I take on that obligation's mine until it expires, right? No. It's no different than I can buy 100 shares of Apple in the morning. I can sell it at noon. I can sell it tomorrow. If I sell a put at 9:30 in the morning, I could go out there and buy that put back or give it to somebody else essentially at 11 o'clock in the afternoon or 2 days from now or 5 days from now. So as the market goes up, that put starts losing its value. I can say, hey, anybody out there in the market, I want to get rid of this thing for $3. Is there any takers? Somebody says, oh yeah, I'll close out my trade and I'll take that obligation for $3. Great. I sold it originally for 5. I just bought it back for 3. I pocketed $200. So I know that was a very, very long-winded description. To be fair, Glenn did say that I can talk a lot.
It's all right, but you know why I like what you do? Because you've given an in-depth answer to Lisa's question. Now, hopefully that made sense, Lisa. Just like, in the beginning, puts go up in value when the stock goes down. If I wanted to do the opposite and I wanted to be bullish on it, I would sell a put above the strike in hopes that it stays above the strike, because if I bought it and it goes down, that's good. But if I sold it and it goes up, that's also good if I sold it. All right, so That is the way. I could be bullish on the stock by buying a call or selling a put. I could be bearish on the stock if I buy the put or sell the call. All right, and Lisa says, absolutely, I had another aha moment. Thank you. Thanks to you and Ron. And I love the way Ron explains things. All right, so something else that happened. John says, Mr. Glenn, I like your shirt. There you go. I appreciate that. Clay says, do you have to own the shares to buy calls or sell puts?
No, not at all. If you're going to buy a put, or I'm sorry, if you're going to buy a call, buying a call is the equivalent of being long a stock. So you don't have to own any shares. In fact, you don't have to own any shares at all for any options trade. You can sell a put without, and actually selling a put with the stock really doesn't provide you any additional comfort or any additional relief, because selling a put would be more in the terms of being short the stock that way. Now, if you want to sell a call, if you own the stock, that helps a lot with margin, because when you sell a call, you are taking on the obligation to provide stock to an option buyer at a certain price. So let's say I'm doing a trade and the stock's at $100 and I own the stock. I can sell a $110 call without a lot of margin, or really with any margin, if I own the stock, because I already own it. So if I'm providing it to somebody at a certain price and I own the stock, that's great. Now, if I don't own the stock, I can still sell that $100 call. The only difference is I'm going to have to put up a lot of margin to do it. Most brokers, and this is kind of it's not a guarantee, but I'm just going to give you an estimate. If you were to sell an option like a call on a stock that you don't own, they're going to have you put up roughly 25% of the stock price. That's going to be your margin requirement. So you never need to own a stock to sell calls, and you would never need to own the stock to sell puts. You would just have to put up the margin to do it. The only way owning a stock helps you is if you're selling calls, because now you actually have the collateral. So the broker doesn't care. Oh, you're taking on the obligation to sell stock. Oh, you already own the stock, so we would just take the stock from your inventory and sell it. So you wouldn't have to put up any money to do it that way. That's considered a covered call.
And then once the stock goes away from you, it's called being called away. So, and if it's the opposite, if you sell a put and it goes against you, it's called getting put to you. All right, so the obligations are there, but if you own the stock and you're not selling the call naked, you own the stock, as Ron just says, the collateral is there to be able to overcome if the trade goes against you. You sell it naked, you still have the same obligation, but if you don't own the stock, now you have to provide the stock to the buyer. All right, so the little intricacies go a long way in understanding how to trade options, and understanding the little idiosyncrasies are what's going to make the difference between a profitable trade and an unprofitable trade. And if sometimes that unprofitable trade happens, you sit back and go, what the heck just happened? You got to understand the little things. And I like Lisa's statement. I have a lot more research before I pull the trigger. So on options, just to let you know, I don't like to sell you anything in here, but we do offer an options course, 2 options courses, one for the beginning investor in options, and one for the more advanced person in options. The first one is called the Options Jump Starter course. Just like how you jump start a car, well, the Options Jump Starter is going to jump start you into the world of options. And then the Options Paycheck course, a little bit more advanced, is going to show you how to generate monthly income. So put those 2 things together. You're going to be able to learn a lot about options, and you're going to get it from the one source that you come to here to learn about the market. We can help you as far as options are concerned as well. And I have the Options Pro tool that Ron teaches a lot about, that we can look at a little bit today in regards to some stocks that you may be interested in. So all you guys, again, still sitting in the background, this is the day you needed to be here, especially when it comes down to options. You're going to get a hell of an education today. And guess what? Just like Lisa says, You're going to possibly get an aha moment, number one. And number two, for many of you who did not think that we could aggressively teach you options, I'm going to put that misnomer to bed today as well. That is an additional tool, but you're going to see a lot of the flexibility and the power within that tool that if anybody who's sitting in the background saying, well, I know about options and, fine. Guess what? We're going to blow your socks off. Make sure you got clean feet because you don't want to have stinky feet once you blow your socks off. And we can blow your socks off today. Lisa says, we have it and watch it as much as we can. Love the VectorVest training program. So there you go. So I don't have any new questions right now, so let's take this back a little bit. Ron, in regards to, and let's just start with basic calls and basic puts. Tell me some of the little idiosyncrasies that go in line with tying up the best possible options trade. And if you need me to open up the Options Pro tool, I can do that. But I want a nice little background of what you look for before you start to place a call or a put.
At the end of the day, it really still revolves around chart patterns. I still like, and of course, VectorVest is number one. When I look for a call or a put, it really isn't so much about the option at first. It's still about the stock. It's got to have good, and then this again gets into VectorVest. It's got to have good relative safety. It's got to have good RT. It's got to have good VST. Some of the things that are, our bread and butter here at VectorVest. And I like some of the searches in VectorVest, like, premier growth stocks. And I like Vector plus Vector 125, basically anything that's out of like our prudent and retirement folders, because those are good, solid stocks. I don't like trading, and this is what I tell a lot of I teach a lot of what I call income students or income concepts. I'm not a huge fan of trading things like, things that are very, very high risk, a stock that might be $1 that could go to 35. I like good, solid blue chip type companies that when the market's bullish, kind of like it is now, it's got good growth, it's got good earnings, the stock looks good. Then I go over to a graph of the stock. I want to make sure that in a 1-year graph, the 1-year graph is bullish or bearish. If I'm buying calls, I want to make sure it's bullish. And just do it simply. It doesn't have to be a lot of work. You don't have to go in there and look at MACDs and things like that. Yeah, Glenn, throw up any symbol in there, Apple, right? What I like to look for, that looks like about a 1 year.
That is a 1-year graph, my friend.
If you look at the left-hand side, right, the first bar on that graph, it's trading for, I don't know, I can't even see what, like
about 160?
About 160. And then at the end of the graph, it's trading for over 200 now. That right there, and I know it doesn't look perfect, but that right there is the signs of a 1-year bullish behavior. It's 1 year later, it's higher than it started. That's the kind of basic stuff that I look for. And then I go to a 3-month graph, and I make sure that over 3 months, we're looking good. And if it's the same concept, which it is on Apple, you can kind of see it. I don't even have to look at the prices. This is the kind of stock that I like to go bullish on. And in fact, we actually did go bullish on Apple. I'm looking at my trading account here. Let's see, account statement, Apple. And what we did on Apple in the last couple of weeks, let me take a back and look here. We did Apple. Now, what I do, I'm kind of a credit trader, but from the side of just if you were going to do a call. Now, it's not a good time to do a call right now on Apple because Apple has earnings like in the 30th, I think?
Yes, it's either this week. Well, it's next week. Sorry, it's next week.
Okay. Yeah, Apple's not a really good time to be buying calls or puts on right now because of earnings. Earnings are kind of a mixed bag. You don't know what's going to happen on earnings. So what I tell my students is, unless you're trading the earnings specifically because you want to play that 1-day move, anytime when you're under 14 days to earnings, it's a bad time to be buying calls, buying puts, really doing much. Okay.
And look at this 3-month graph. Look at earnings. He's right on board with that. Look at that.
And it was beautiful. I mean, like I said, I did more of the income credit spread for Apple over the last couple of months. I think I did actually Apple. I've traded Apple pretty much a lot this year. I think I've put like 4 trades on Apple this year. But what I look for is a graph that looks like this. I, of course, want to make sure that earnings are at least, when I'm buying a call, you really want earnings to be at least a month away. Because when you buy a call, you got to give the market time to maneuver. You can't, it might take 1 or 2 days to get some money, but you want to give it time. Now, when I buy a call or when I buy a put, keep it simple. I kind of focus on what I like to call the sweet spot. Now, for me, the sweet spot is how much money, how can I keep my investment on Apple as small as possible to maximize my rate of return? Now, some people on Apple or some people would buy a leap. And if you don't know what a leap is a long-term option. That might expire in 2021, 2022. That's a leap. They're very, very expensive because you have to buy a lot of time. Now, some people would buy a delta that's really high. Now, if you're not familiar with delta, delta is essentially the rate of change of premium based on a $1 move. So if I bought an 80 delta option, that means every dollar that Apple goes up, my option premium increases by 80 cents. So basically, I'm making 80 cents a share for every dollar Apple goes up. Now, is that a bad thing? Buying a real long-term option and a real in-the-money delta. Is it bad? It's not necessarily bad. But what you're doing is you are locking up a lot of capital to do it. So when I see a trade like this, what I tend to do, and again, earnings notwithstanding here, I try to find a sweet spot. Where can I put out the little amount of money and where can I maximize that rate of return? So typically when I see something like this, I try to go out usually between about 45 and 60 days.
Do you want me to open up Options Pro at this point?
Sure, go ahead.
I need to do it a different way, Joey, right?
No, you have it down there on the bottom.
Oh, I see it.
No, you see it. I don't.
Right, it's down there, isn't it?
That's OBX. I don't know what that is. I don't know. No. Hold on. I don't see it here. Oh, there it is. There we go. I got it. Now you can see it and I can see it. Okay. You good?
Okay, yep. Open up an option chain.
So if you look over to the left, there it is, options chain. Okay. And I'm going to put in the symbol for Apple. Ta-da! All right, so as Ron is about, I'm probably going to maximize this. The options chain shows you all of the different strike prices along with their expiration days, when they expiration, the different prices or premiums for the different options strike prices as well. And then all the other Greeks behind it. Go.
So what I would probably look to do is buy something in June that's about 57 days to expire. And I try to keep my delta really between, I would say, 50 and 65. So that 205 option right there actually looks pretty darn good, that June 205 option. It costs about $8. And what that will let you do is this. Now, in an option, and again, it starts to get a little bit, I don't want to even say it gets more complicated. These are just things that you have to know to be an options trader. When I buy a June option, right? Glenn, go ahead and put that in the, if you, click on the ask price. Just left click.
I did.
Okay, it just takes a couple seconds for me to see it.
Okay.
And then right click on the, actually instead of doing it, just go to this, go back to a risk graph.
Okay. Apple, there we go. Oh,
And then
go ahead.
just populate the risk graph with that June 205 call. Now, again, I want to be clear. I wouldn't do this trade right now because earnings are coming up in like a week, and you want to trade around earnings. But what happens here is this. When you buy an option, all right, two things happen. Number one, if the stock goes up, that's great. For every dollar Apple goes up, I'll make 55 cents right now because the delta, I think, is around 55 if I can see the screen. And actually,
the delta is sitting at 50, yeah, pretty much 50.56.
Okay, cool. Yeah, I'm looking at it on my screen too. Now, what happens here is every day that you own this option, it starts decaying in time. So 2 columns over from delta is the theta. Theta represents time decay. And if you see that, it says minus 0.07. If Apple goes up $1 tomorrow, okay, the price of that option is going to go up 56 cents based on the delta, but it's going to lose 7 cents based on time decay. Now, by buying the June, what we're doing is we're delaying the time decay of this option. What happens with time decay is time decay really, really picks up in the month of expiration. You could have a delta 55, and if this option expired in 2 weeks, that delta, that theta might be 25 or 30 cents. It might be something ridiculous. So sure, every day the stock goes up, you might make 50 cents on delta, but you might lose over half of that on theta. By buying these options, and again, I kind of like to use 45 to 60 days as my window. I've basically put off any time decay worries until June 1st. I now have a good solid 5 weeks that Apple can go up in price without having to worry about time decay. So that's kind of why I like to do that. Now, what I also like to do, I don't like to go too deep in delta. The higher the delta, the more this option ultimately costs. The more it costs, if I have, let's say like in this option right here, it has an $800 investment. Let's say that I think that Apple is going to go up to $230 a share by the expiration date. That means I'm going to make about $1,500. Okay, you can kind of see that on the risk graph. I don't know if you can see all of it, but around $230 would give you about a $1,500 or so move. Okay, now to get that $1,500 move, I have to invest $852. That's a pretty good return.
Right side. Hold on, Ron. Can I get the right side?
Yeah.
All right, Joey's going to work. There we go, Ron. Now you can see it all. Okay.
All right, perfect. And then you can kind of see over on the right-hand side, you see that solid blue line? Okay, this is a risk graph for an option. And, you know, if you buy 100 shares of Apple, it's easy. If Apple goes up $1, you made $1. You made 100 shares or $100. Options are a little bit different because you've got things like delta and you got things like theta and, you know, volatility, which is not a huge concern. But I mean, it's a concern, don't get me wrong, but it's not something you need to like endlessly obsess over for a long call or a long put. If the stock goes to 230, you're going to make about, you know, I think it's like 1,500. I think you're on, like, are you on 230?
I'm going to go 220.
Might be off.
Yeah, 229.44. I'm right there.
Okay, and what's your risk graph show?
I'm showing 229.44 0 as far as the on the white. Hold on. 229.
Yours looks a little bit different than mine. You're doing a 205 call, right?
I'm doing a 205 call, June 21, 2019 expiration.
Okay. In the lower right, well, see, I don't know, it's kind of weird. I can't see the cost of is it about $8 in premium right now?
Do me a favor, take me off screen so he can see the bottom. Hold on. There we go. And to say it again, I got a mid price of $850 total. I got $850.
Okay. So yeah, it should, and maybe.
And it shows me my debit at the right is $850.
Okay, that's perfect.
Yeah.
And then in the lower right-hand corner of the risk graph, there's that little reset button. Right, go down where it says probability of expiration.
Yes.
And go to the left of that. There's like a little reset button. It looks like an arrow.
Yep.
Click on that.
Okay. Does that look better?
Let me see. Yes, it does.
Okay.
Okay, that's a little bit better. Now, let's kind of do it this way. Do you see the price right around 225? It's right by that little purple bar.
225. Hold on. 260.
On the right.
On the right. 220.
You can kind of line it up. It should be near that purple bar.
I got it.
Just to the left of where you are.
Okay.
So, yeah, if you just go straight
224.30.
up there. Yeah, there you go. And just match that blue bar.
right?
Match the solid blue line and
To
kind
the
of put your crosshair right there.
225. Okay,
Yep.
I got 224, 222.
It's like $1,200, $1,100 in that
There we
area.
go. There we go. 1149.48.
Yeah, that's about right. So if the market, let's say, went up to around 225, right? You're going to make, let's say, 1150. You have an $855 investment. So it's got better than a 1-to-1 return. So let's kind of do a sample here. Glenn, click on Edit Spread.
Right here. Okay.
And we will change this to, let's do a 185 call. So just change the strike price to 185.
Bingo. Click on OK.
Yep.
There you go. And there you go.
Okay. Now go back to that purple bar and match that up with the same thing that you kind of did already.
220.
Just go to that purple bar and then go up.
And I'm sitting at 1625.
Okay. Now, are you making more money there? The answer is yes, I'm making more money. Okay. Here's the problem. What does that trade cost you to take?
Ah, look at that.
Your rate of return is a lot less. So Delta gives you a lot of leeway, but going deeper in the money lowers. Yeah, I'm sure you can say, well, Ron, I made 1,600 instead of 1,200, but you're also risking 2,300 versus 800.
And those are the little idiosyncrasies, folks, right there that make a difference in the trade.
That's why, I still feel that when you're buying a call, and this goes to buying a put as well, your best course of action is to find that sweet spot. And we like to go out usually about 45 to 60 days. Okay. And we like to keep our deltas between 50 and 65. And I kind of like to go maybe in the mid 50s as my starting point when I'm buying a call. But in that 50 to 65 range is going to be the best rate of return, the least amount of risk, and ultimately your best chance of success. That's where you're going to, get the best bang for your buck. And like I said, going out in time, doesn't help you either, because a lot of people will say, well, Ron, what happens if, Apple goes up and it just keeps going up, but my option expires in June? Great. Exit the trade. If I'm up $1,500 or $1,100 in Apple and I'm approaching that June expiration, you still think the stock is bullish? Awesome. Get rid of your option and do the exact same thing again. Go out 45 to 60 days, buy an option that's between 50 and 65 delta, and you will just continue on with the trade where you're not buying all that expiration for no reason. Because if this trade goes against us at 185, we've got a $2,300 risk. Even if we only risk half of that at $1,000, okay, you're going to still lose $1,000 if this trade goes against you. Or if you let it expire worthless, $2,300. By doing the 1 or 205, you only have an $800 risk. Now, you could make the case of, and again, well, people say, well, Ron, the delta's higher, I'm making more money, but not on a rate of return basis. Yes, you're making 90 cents every time the stock goes up $1. But because the cost is so high, it's not giving you the best rate of return. That's really what it's all about. That to me is kind of like the sweet spot of option buying. And again, you have to be comfortable, because I do this all the time too. If I think Apple, and I told you guys earlier that I've been bullish on Apple. I've done 3 trades on Apple in the last, let's see. Let me go back a little bit more. 40 days back. I'm looking at my trading statement here. Go back 60 days. All right. Okay, there we go. I first did a trade on Apple on like March 13th, and I exited my last trade on Apple on 4/23. They were all variations of bullish trades. Now, again, I don't buy calls a ton because I like to do spreads. But, on 3/13, I entered my first trade on Apple. I exited with profits on 3/20. I still think the stock is going up. On 4/1, I entered another trade. I took profits on that on April 8th. On April 8th, I entered another trade. I took profits on April 23rd. And now I'm just basically sitting here stagnant on Apple because earnings are so close. So even in something like that, I take my profits, roll the trade to something new, and then I go to another trade because I'm minimizing my risk. I'm keeping the risk small, not buying those leaps, not going out way too much time, way too much in the money. I'm just keeping it focused to reduce my risk and increase my rate of return.
A couple of things that I heard in all of that. One, did you hear him say that he lost money in any of those trades? That's number one. Number two, love the idea of being able to risk a smaller amount of money. Just like he said, if the trade goes against him, buying the 205 call, I have at risk $855. But if I go deeper in the money and I go and get into that, what was the strike, 185? You know, I stand a higher chance on making money. All right, what's my delta? My delta's at 90 cents. 90 cents for every dollar the stock goes up. I make 90 cents on the trade, higher probability. But look at that, $2,300 at risk. So the beautiful thing is learning how to tailor the options. And just like Ron said, the sweet spot. I want to expose myself to the least amount of risk by way of output or outlay of cash and still maximize on my profit. So on this trade, the stock goes up $225. I'm up $1,600, but I had to risk $2,300. Change the spread, change the strike, bring it closer, 205. Same point. Now I'm only up $1,000, but I have a lot less money at exposure in case it goes against you. And that's key. How much are you willing to lose? When you put that trade on, that's the most amount of money you can lose on the trade. You want to minimize that as much as possible, and that is what is cool. And I love the explanation because, again, for many people, that may be an aha moment. That may be an aha moment, setting up the trade to minimize how much money you're going to lose. Because inevitably, the reality of the market is that not every trade is going to make money. If that's the case, let me lessen the probability of how much money I'm going to lose than not. Now, let's break this out real quick. Ron, I want to analyze a trade. Tesla. I'm going to put in Tesla, TSLA. This comes from B. Wooster. Tesla, over the next 6 months with the options, looking at the June 255 buy. Let's change the strike. Edit the spread. June 255 on Tesla. Let's set the trade up. And I don't think that's right either. Let's do is that right? Does that look right?
Well, let's see here. I imagine he's doing a put spread.
Oh,
so buying
okay.
a 255 put and selling a 260 put.
All right, buying
Or reverse. You could do that either way. Buying a 250. Wait a minute. I'm going back to seeing what he's doing. Looking to short tests over the next 6 months with options. Looking at June 255 buy and 260 sell.
All right, let's go bearish. Does he want to do a bear call or bear put? It's a spread.
What? Let's see. Buying a 255 and selling at 260.
That's
the only problem is
that's a bear call.
Well, the problem is that's a bull put. 255 put, 260 call. Okay. So you're basically looking at doing kind of like a synthetic idea there.
All right, so he's got a 255 put, 260 call.
Yeah, he's basically doing kind of like a synthetic short position. A little bit, not quite the same because he's separating the strike prices. So yeah, that's what he's doing. I don't really have a problem with that. Now, the key is, and you could put that on a risk graph. That's a very advanced position.
Which one
for a lot
I want,
of people.
synthetic short or?
It's not going to come up in Options Pro because it's a separate strike price, so you're going to have to build it manually.
All right, let's.
So, what do you got on your?
I got the June 21.
Okay, click on Edit Spread.
Okay. Long call.
Okay. And then what we're going to do is we're going to sell a June 21 260 call.
I'm going to option leg add, sell a June 260 call. One, they both calls, or one is a call, one's a put.
One's going to be a put.
The 255 is the put. The 260 is the call.
Right.
Both June expiration.
Yep.
Click on OK. There's the trade.
Yep, and that should be pretty much close to what it is.
Okay.
If I, let me see here. You have, let me see here. You're selling the June 21st 260 call, correct?
Yeah, yep, I got the June 21st 260 call and buying the 255 put June.
Okay. So what that trade basically does is they call this kind of like a synthetic short, where you're buying a put, right, because you think the stock is going to go down. Then you sell a call against it. And what happens is it reduces the overall cost of the trade. So instead of just buying a put for $22, he's selling a call against it and bringing in $15 in premium. So he has basically a $6 net cost in the trade. It's just a cheap way of doing it. It takes a lot of margin and capital, but that's okay if you have the margin and capital. It's all good. Now, I assume what you're probably going to do, because you sold the 260 call, I really don't have a problem with this type of trading. I think it's great. It's a cheap way to be bearish on something. I think it's awesome. The only thing is, it's just a matter of, at this point, now you'd have to have profit targets on it. Where do you think it's going to go? Ultimately, 260 is where I probably would put a stop on this thing, because you sold the 260 call. Anything more than 260, if the stock rallies, that's where your loss starts getting a little bit more crazy. So if that's what your idea right there is, to put a stop at like 260, I think you're in good shape. That's a very advanced trade, by the way, and not a lot of people can do that. But no, I think that's great. You're offsetting the price of a put by selling a call. And that's, like I said, that's what we call a synthetic short, but with different strike prices, the software won't recognize it. I like it. And then just use some sort of trailing stop for it as the stock goes in your direction. And yeah, it's a pretty good looking trade.
All right. Clay says, how much would you recommend having to start trading options? How much money do you think you need to have to start trading options?
It doesn't matter. It really, really doesn't. I mean, you can open up an account for $3,000, $4,000, $5,000, $2,000. The big thing with any type of trading is risk tolerance and risk management. It's I always like to say this is like a credit card, right? I could go out and charge $35,000 on my American Express. Problem is, at the end of the month, I have to pay for it. And I'm not going to do it because I really don't want to come up with 35 grand at the end of the month. That would really throw off my finances quite a bit. So I don't do that. Even if you're trading a $5,000 account, instead of trading 10 contracts of something, you trade one contract. What I would recommend, regardless of how much money you have in your account, we try to keep our risk, and even with options trades, we try to keep our risk to about 2% of our account balance per trade. Even on something like Tesla, right? Now, you'd have to have quite a bit of money to do Tesla on this trade. But with Tesla, I would be risking on this one contract only about $673 if I exited the trade at 260. Now, even though this trade costs a lot of money, on one contract, it only has a $680 risk if I get stopped out at 260. I look at what the trade would go against me, and I just want to make sure that is less than 2% of my overall account balance. So I don't have any minimums. I don't think it makes a big difference. What makes the big deal is just structuring the trade so you're not risking 20, 30, 10, 15% on simply one trade.
I'm going to give you a real life story in regards to that, Clay. I've been with VectorVest for 15 years. When we first started at VectorVest, after a year's worth of being here, as a reward, VectorVest gave us a check for $2,500 and said, go invest it in the market. I took $1,000 of that money. Don't worry about the other $1,500. I took $1,000 of that money, and I started here in 2004. I took that money, so I started in 2005, and I started out strictly with options. All right, why? Because $1,000 wasn't going to buy me a lot of stock. So I got into a lot of lower dollar stocks. I learned to use delta. I learned to use probability to make sure that the trades that I was in was good. I turned that $1,000 into over $90,000 in 8 years. Now, the majority of the trades were options in the beginning. And the beautiful thing about what I did, is I got in at the right time, 2007, 2008. You do know that when markets go down, stocks go down a lot faster than they go up. I made the crux of my money trading puts during that time, during the housing bubble. A lot of them, and I could flip that over and over. Another thing, I traded a lot of Apple. As my money grew, I traded a lot of Apple, and at the right time, Apple just made me money hand over fist over and over again. And I did partake in a leap because I was saying to myself, I want to hold this stock for my daughter so that she can, the Apple was just making so much money that I would close out at a leap at 50, 60, 70, sometimes 100% gain on the option. So that's the answer. That's to answer your question from a real live perspective. From a real life perspective, a $1,000 portfolio grew into over 90,000. Took 8 years to do it, but that's a lot of growth, and a lot of it was all options. All right, so now, good question, Clay. Lisa has a question. So what's the difference between delta and theta times 100 shares in the strike? Is your profit for the call, i.e. 49 cents times 100 is $49 per dollar, 49 per dollar for the stock raises. Is that right? So I'm going to let you answer that, Ron.
Yep, I just read it. That's exactly right. Times 100 shares, that's right. The difference between delta and theta times 100 shares is in the strike is your profit for the call. That's correct. So you take those two things, you take your delta, you minus the theta, and if the stock goes up $1, that's what you would make. And if the stock goes down $1, that's what you would lose times 100 shares. Now, there's other things involved there too. There's like the Vega. Vega is volatility. So, if volatility goes up 1% over the course of a day, that would add, whatever the Vega is of the trade. You don't have to worry about Vega as much if you're doing just long calls and long puts, because it's just, I don't want to say it's not applicable, because Vega is very important depending on the type of trade you're doing. But on a long call or long put, the individual Vega is not so much important as it is whether the option is, and this kind of delves into another thing where I'm opening a Pandora's box, that also kind of delves into whether the option is inexpensive or expensive, if the premium is too much or too cheap. So Vega takes a little bit in that too, but the main thing is going to be your delta and theta for a long call or long put.
A good way to understand delta looks at a percentage price change. Notice that theta starts with T, that's time. Gamma starts with G. Hold on, I used to know that. What is gamma? Real quick, what's gamma?
It's the rate of change of delta.
Okay, what's Vega?
Vega is volatility.
So V, volatility, what's rho?
Rho is interest rates. So if interest rates go up like a point, the option would lose 20 cents or whatever.
So that's a simple way, time, value, and interest rates. Begins with the letter. That's just that's me just throwing out a little something, little something. That's all it is. That's all it is just a little something. All right. Let's do this. Any other questions? I'm gonna do something else. From an option standpoint, it popped up. From an option standpoint, I'm going to give you an opportunity from a graph perspective to take a look at some possible options. Does anybody have any stocks that they want to look at? We've got about 5 minutes left. Does anybody have any stocks that they want to look at? And as we look at this stock, I'm going to let Ron, at least from a graph, be able to start to think about what kind of an options trade, if any, you would consider playing on that stock. So again, if you have any stocks, this is the time to talk about it. Again, I'd love to see that. Notice that Daniel put in here, exclamation point, options paycheck. If you're interested in the options paycheck, there's a link for it. Thank you for that, Daniel. But again, any trades or any stocks that you're looking at, this is the time to put them into the room. Let's take a look at it. And from the graph, Ron can do a really good job of explaining if there's an options trade available for it, if the stock has options, if there's an options trade available for it, and which one. So we already looked at Apple. I'm going to put in a stock that did bad today, 3M. I'm going to put in some stocks that I know. How about DDD? There you go, 3D technology. I'm going to put in some another wide way. There we go, Ellie. Can we check Yeti? Yes, we can. YETI, comma, and Ulta Beauty. ULTA. We track 8,331 stocks. I know the ticker symbol for 8,240. So there we go. Let's look at the spiders. Is that really a stock, Joey? Moo?
I don't know.
Then why did you put it in there? I don't want that one.
Is it not one?
That's why I don't want it. I don't know what it is. I don't want it. Moo. All right. It looks like it's a fund. Van Eck looks like it's a fund. I made some money with it a couple of months ago, says Digital. Oh, that was Triple D. All right, anything else? If not, 3, 2, 1. All right, so Ron, first thing you want to look at is a 1-year graph. So here we go. Based on what you see with 3M, what do you think?
Well, after today, it's really, really ugly. What I do on something like this, I have kind of a wait and see approach after earnings. I mean, overall, the stock is kind of neutral over the course of 1 year. You know, it's a very, very neutral stock. It's pretty much the same place it was as it was last year. So over the 3 months, it's rallied. Now, what I would say if it didn't have a terrible earnings session today, I would probably say we could be bullish. But see what I mean by earnings? And this is why I tell people to try to stay away from earnings if you're doing something in a more if you're just more of an investor and you think a stock is going to go up or you think a stock is going to go down, you generally stay away from earnings events because the stock went $27 down today. Now, what I do is I typically, after an earnings event, I wait because this could be a huge overreaction. I mean, they had bad earnings. I didn't read the earnings reports and I really don't care, to be fair. It could be an overreaction. Now, what I look for on something like this, if you want to play this bearish or if you want to play it bullish, it doesn't matter to me. You need to wait for some sort of a follow through. We had a big move down today. Now, is the follow through going to continue moving this stock lower over the next day or two?
Good point, my friend. That is a good point.
And if it does, well, I would simply go out to June, buy a put with a delta around 50 to 65, and play it that way from a long put perspective.
All right, let's go take a look at the next stock. That looks like Condor territory to me.
DDD?
Yeah.
Yeah, but it's very, very cheap, so you probably wouldn't get a lot of premium.
Okay. Condor, just so that you know, we can make money on options going up. We can make on the stock going up. We can make money on the stock going down. There is an options play to look at a stock moving sideways, known as, and you don't have to get into it, but there is a way to make money if a stock just sits sideways. But you're right. It is a lower dollar stock, and I don't know if it does or does not have options, but it is lower dollar. You're probably not going to take in a lot of premium.
It does. It has earnings on May 7th. So on something like this, it's kind of close. But if you really wanted to before the earnings announcement, you have about a week and a half to try to collect some premium on this thing. I mean, I'm looking at the options right now, but the problem is there's just no open interest and there's no liquidity. We can't do anything with May because May is a little bit too close. June has some liquidity, but there's just not a lot of premium. I mean, overall, this is one of those types of stocks that honestly, I'd probably leave alone. And this kind of goes back to what I was first talking about. It comes back to chart pattern. I don't have a problem with trying to do something on this, but it's got to show me some direction. And right now, it's not a good play for sideways just because there's not a lot of open interest in premium. See, this is one of the things that a lot of people do and get into trouble with when they come into option selling. If I were to sell some sort of premium on this thing, I'm just going to look at it on my screen right now, and I'm just kind of curious. Chain, if I go out to June and try to sell some low probability premium, I'm going to have to see. Because that premium is so low, let's take a look here. If I went to like $14, 14, that's even worse. And then there's no liquidity out there either. So from a neutral perspective, there's just not enough liquidity. And then from a directional perspective, I mean, you're in a stock that has $11.50 top and about a $10.50 low. So to me, I would be waiting. Now, I would still go back to whether I'm bullish or bearish. It doesn't make a difference, but it's got to break out of this channel. If it breaks out of the channel, then I would go into my standard option rules. Normally, in something like this, like Glenn said, he was talking about an iron condor. An iron condor is beautiful. You sell something like a $12.50 call, you buy or sell something like a $9.50 call, and you're playing this stock to stay in a range, which is beautiful for this type of market. But the problem is there's no liquidity on those options, and the premium is very low. You might be bringing in, let's say, $100 in premium, but having to risk $2,000 to collect it, and that's the real problem. And there's always an option. There's an option adage about selling premium. A lot of people fall into this trap. Oh, I've done that before, but that's like picking up nickels in front of a steamroller, right? That's what this would be. Be picking up nickels in front of a steamroller. It may work 9 times out of 10, but that 10th trade, it's going to cost you everything you made in the previous 9 plus some more. So you got to be careful on stocks like that for those sideways trades when there's no premium and especially no liquidity. But for directional, now we just got to break out of the range.
And now for your question, to answer your question, Daniel, so you want a higher dollar stock? Just because it's always a higher dollar stock doesn't always mean that it's going to yield a high premium. There's a lot of higher dollar stocks that sit stagnant. So it's not that you want a higher dollar stock. This is where you look to see what kind of premium are you going to get for selling it. If the premium is not there, there's always another stock. And it doesn't always have to be a higher dollar stock.
Right. There's times when Amazon is in that same situation. Even though Amazon is, I'll be honest, I haven't looked at Amazon. $1,700 now. $1,900. I haven't looked in a while. Amazon's $1,900. That doesn't mean that the premium return is going to be enough to facilitate selling premium. Or I can do it on a $50 stock that's trading high premium right now. So it's not always in the options paycheck class. I have this in my first lesson. I say one of the biggest mistakes of selling options is just focusing on the premium. Oh, it's a $1,900 stock, so premium is high. Well, sure, it's high. It's a $1,900 stock, but that doesn't mean that the premium is overpriced or very expensive for the stock. You got to look at the underlying variables of it too.
All right, let's move to the next stock. Thank you, Ron. You're awesome. Yeti. Woo! In my mind, that looks, and I'm just going to give my perspective, in my mind, that looks like a good call. Problem is, the stock's price is very close to resistance. I would like to see the stock break out of that level of resistance. Buy the call. I can buy the call at that resistance level. If it breaks above, that's great. All right, that's my perspective. Definitely would be more bullish on the stock than not.
Agree. I am 100% with you. That's the first thing that stuck out to me is it's trading right at the previous top.
All right, there we go. Let's see.
Plus you're really close to earnings too.
See, and that's not another thing that I'm looking at. That's not a thing that I have at my disposal right now to see earnings. Ulta, little bit of a sideways move. You don't know if you want to be bullish or bearish on the trade. And I bet you that if you look at either side trying to be bullish or bearish, I bet you that the open interest is probably about the same on both sides. Or another, again, maybe probably another condor type of situation where the stock is moving sideways. Ron?
Yeah, I mean, it's got a little bit. I'm trying to look at some of the tools I use. It's not quite neutral enough for me to do an iron condor.
Okay.
I mean, if I was playing this stock, I'd probably play it more bullish just because it's overall bullish. The only thing that bothers me about playing it bullish today is the fact that it's down.
Yep, it's a down candle. Always make sure, whether you're bullish or bearish on the stock, make sure on the day that you enter the trade, the stock is doing exactly what you want it to do, or wait for a better buying opportunity. Good call there, Ron. All right, next one, the spiders. Woo! And what do you see right there? That's a level of resistance. Where's it at? Just trying to breach it, but I'm with, just like the other stock we just looked at. It's got more bullishness to it. It's got more bulliosity. That is a Glennism. It's got more bulliosity in it. The 3 and the 8 look good, but it is at a level of resistance. Ron?
Same thing here. I've been playing the SPY. I really don't play the SPY. I play the SPX, which is the index option. And the reason why I do the SPX over the SPY is because it takes me 10 contracts of the SPY to do the same thing as one contract of the SPX does. And the SPX it's kind of goes into a longer story. The SPX is cash settled. There's no stock behind it. It's just a cash instrument. I've been playing the SPX bullish pretty much all year since that December low came in. I would still play this bullish. Now, what I do when I play something like this bullish, I use what's called a bull put spread. So if I'm playing this bullish, like for instance, I actually just got out of my SPX trade this week to show you kind of the equivalent, right? I put on a trade on the SPX. I did this trade, and it took a little bit of time for it to get profitable this time. I put the trade on 4. When the hell did I do it? 4. Sorry, that's my trader tongue coming out. It does that sometimes. I apologize. I did that trade on 4:15. So if you go back to 4:15, even on the spider.
There's the 4:15 right there.
Yeah, that was like last Monday, I think.
I'll zoom in a little bit. 4:15. Yep. There you go.
So what I did, now the SPY on 4:15 was what, about 20 or 289.20 or something?
It was close price 289.97.
So what I did is I sold a put, and I did a put spread. I essentially sold if the equivalent of the SPY, I would have sold a 282.50 put. Somewhere
up in here.
So pretty far below that market.
282, right about, I'll leave it there, 282.39. Right about here is where he sold it.
Yep, so I sold a put there, and then I bought the equivalent of a 280.50 put.
280.50 further down here. So now the beautiful thing about that trade, as long as it stays above the strike that he sold, he's great. But for protection, he bought a put a little lower, just in case the trade went against him. He's covered. 280. I'm gonna put it right about 280. There you go, and make that a little. There you go. And as long as it stays above the strike, he's good. All right. So, last stock, Moo. Joey put that in. I don't know why he put that in, but who looks at, I don't even want to look at you right now, Joey. All right, put this back on a 1 year. Always remember, as you're looking at the trades, you always want to start off with a 1 year graph, What do you think? I'm still thinking more bullish. I got some more room to up to that level of resistance, but look at the last couple of days.
I agree. It's very neutral over the year. The last 3 months have been great. Now, the question is how well do you like trading retracements? Do you like trading stocks that come down? I don't mind. And this is one of the things that I know you have candlesticks on there, but I'm more of a bar guy. I look at today's price on this and I see a potential reversal. Because I see, if you compare it to the prior day, we have a lower high, a lower low, and a close above the open and a close above the midpoint. A lot of times when that happens, that's where you tend to see reversals occur. You saw it back on 325, you saw it back on 3.8, and you saw the same concept back on 2.8 as well.
All right, and I'm going to put one more stock, Ron, Disney, and that's for Ralphie. Disney, 1 year, what I see, nice run up in the middle of the year, late September, October, November, and at the end of the year, actually. Stock went through a little sideways move, dropped, went back up. You know what this looks like, what I like to call? It looks a lot Loch Nessy. It looks very Loch Nessy, but overall, over the year, has risen. A big upward move. My situation here, would I be bullish? Yes and no. Look at the parabolic move on the stock. A lot of the money's already been made. I'd be a little nervous being bullish at this point. Ron?
Yeah, I would agree, especially because earnings are close. And plus, I'm biased on Disney because when Disney gapped up with their streaming service, I had a Netflix trade on that it hit me on. that irritated me. But, I'll share a hidden thing. It's not really hidden. But one of the things that you can do on something like Disney, and this is one of the things that I teach in my options curriculum, Disney has earnings coming the week of May 8th. What you can do, whether you're bullish or bearish on this stock,
it's called.
you can buy a May 10th expiration. I know it expires in 15 days, and that kind of goes against everything that I told you about for buying options, right? But what you can do is you can buy an option the week of earnings. Now, here's the cool thing about what that does. If the stock goes up, that's great. Now, what's also going to happen, one of the things that causes, and this is a big misconception, a lot of people say, well, Ron, if you look at the VIX index right now, the VIX index is ridiculously low. Doesn't that mean that, option premium is really, really cheap? Yeah, it means that option premium is cheap on the S&P 500 because the VIX is the S&P 500 volatility index. On a stock like Disney, that doesn't have anything to do whether Disney is a cheap option or not. Option premium is based on earnings reports. The closer and closer you get to an earnings report, the more expensive individual stock premium becomes. So what we do when we see earnings coming up, and let me just verify earnings.
And I hooked you up in that I put the Disney stock right along with that VIX for you. Some more of the flexibility that you have within the software that you can do.
So it's not a confirmed date yet, but it says earnings are coming on May 8th. Now, what I would do, or what I do sometimes, and it's kind of cutting it close to the wire. If you were to buy, and this is purely an earnings trade, by the way, I'll just kind of leave you with this one. If you were to go out and buy a call right near the money, maybe around 55 on Disney, okay? Let's say it's a 137 call on May 10th. And let me just look at a couple other things here on my screen. And then, Glenn, we can even put this on your screen if you want to, but let me see here.
You want Options Pro?
Yeah, go ahead and put up Options Pro.
I am going to close this, and I'm going to close this, and I'm going to put up, what was this, Disney?
Disney.
And I have no, what kind of trade?
I'll build it manually with you.
Okay.
Or actually, you know what? Yeah, we'll build it manually. Just click Edit.
Okay. Gotcha.
And then I want you to buy a May 10th 137 call.
I got a May 7th, May 10th, what?
137.
Okay, gotcha.
Okay. And then add an option leg.
Mm-hmm.
And then I want you to sell a May 3rd.
Still 137?
138.
138. There we go. Click on OK. That's what the trade looks like? Or wrong?
All right. Now, what you're seeing here, this is what's called a bull call diagonal spread. Okay? You're selling a 138 call. Now, some people would look at that and say, well, Ron, you're selling a naked call. Not the way brokers work, no. Because you're buying a 137 call the next week. So you're not actually selling naked. You're using a call to offset the margin requirements that you would need. Now, the beauty of this trade is this, right? Here's what's going to happen over the next 2 weeks as earnings approaches. The volatility on that 137 call is going to increase. Now, this gets into a little bit more complicated options trading, but hey, let's just talk a little bit about this, right? When you buy a call, as volatility increases, that means the price of your option will increase. It doesn't matter even if the stock moves, right? If the stock goes up, you make money based on delta. But if the volatility goes up 1%, 2%, 3%, you're going to make another 10, 15 cents for every 1% that volatility rises. Now, what we've done is we bought a 137 call. It's cost us $3.55 or $3.53. By selling that 138 call against it, we've now provided the trade a buffer. So if you look right in the middle of that risk graph, there's that dotted line. That right there is the current price of Disney. Now, Disney, as long as it stays by the next 8 trading days between 134 and 145, we've got a good $6-7 range on this stock to where we are profitable in this position. If it goes up a little bit, we make money. If it goes down a little bit, we can still make money, because what we're doing is we're playing a trade that takes advantage of the rise in volatility on that May 10th option, because that's where earnings is. What happens is, as we get closer and closer to earnings, the implied volatility will rise. It'll go from 28, maybe 29 to 30 to 31 to 32. And you're going to take advantage of that because you own the 137 call. Now, if the stock stays stagnant, that's okay, because you sold a 138 against it, and that gives you room to be wrong on the left. If the stock goes up too much in the future, well, we can also buy back the 138 call and sell something further out, like a 140. This is one of the primary earnings trades that I do, where I kind of tilt it and I play the rise in implied volatility. A little bit more complicated trade, but it shows you the magic and the power that you can bring in with options.
All right.
Now it doesn't matter if it goes up or down too much. I'm just playing volatility and I can make money.
All right, last Panda Bear, tell you what I'm going to do, because we're going to have to end this stream at this particular point in time. Last Panda Bear, I will say that we're going to do this again, but his question was, can you explain how the 138 call isn't exactly being sold naked? Ron, if you can make that a short statement, it'd be greatly appreciated, and that's what we're going to use to end with today.
I can. It really comes down to the broker, and the broker wants to see two things. They want to see two things if you sell a call. Number one, do you A, have the capital, or do you B, have the stock or a stock equivalent? You own the stock equivalent to this trade. You have the right to buy the stock expiring on May 10th at 137. So because you bought that call, it's not a naked position. You have an obligation to sell the stock at 138, but now you have the right to buy it at 137. So you're controlling that obligation with a right to buy the stock, so they don't consider that a naked trade.
There you go. Hopefully that made sense. It made sense to me. Hopefully that made sense, last Panda Bear. Tell you what we're going to do. I'm going to take us into my money-making minute. First off, Ron, I clap, I take my hat off to you, all of that stuff. That was an outstanding session. If you guys agree, type a chair, exclamation point chair. I know it's going to go to me, doesn't matter. Type an exclamation point chair in the room if you felt that this was an outstanding presentation. And Ron, oh my goodness, I think there was nothing that came out that was not answered in detail. You did an outstanding job today, and I am going to step out on a limb. I got no control over this. I'm going to say that we're going to do this again at some point in time. And anybody else who's a Twitcher, I've dubbed you all Twitchers. All right. If you got friends on this platform who want to learn more about the market, make sure they sign up here. If you want to learn more about options, we're going to plan this further in ahead so that you're going to know when Ron is going to come on. But as I mentioned, hopefully you guys feel the same way that I do, that he's one of the most knowledgeable people that have options information. And not only that, he puts it in a way that's understandable without giving a whole bunch of theoretical crap behind it. Yes, that's my trader tongue coming out too. But think about that. Being able to effectively learn how to trade options with the explanations that he's given, and man, oh man, it was outstanding. So thank you all for being here. We did get a follow. Thank you very much, last Panda Bear, for following us. I always invite you guys to follow us. Please do. This is the kind of content that sets us apart from every other channel in Twitch. This is what learning or tuning into something like this is all about. Whether it's me and what I do throughout the week or having a special guest like Ron, you guys are not going to get this kind of education anywhere on Twitch. And that's what we strive to do. So with that, folks, again, if you have Amazon Prime and you want to be able to support us financially without money out of your pocket, there's a link there to show you how to link your Amazon Prime to Twitch. where you have an opportunity to have tokens to give to whatever your favorite stream is once a month. And again, it's a good way of supporting us, number one. Number two, if you're new, follow us. If you haven't followed us yet, follow us. If you want to get on top of different types of people who will come on here and talk to you about how to invest in the market, follow us. All right, so with that, I'm going to sign off for today. Ron, again, man, that was an outstanding presentation. Thank you so much for that. And with that, folks, adios, arrivederci, ciao, au revoir, sayonara. Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.